Welcome to the deep dive.
Hmm.
Today, we're going to be looking at something that might not sound super exciting at first glance.
Okay.
Um, but trust me, this is important stuff.
Right.
We're talking about directors and officers liability insurance, but we're going beyond the basics today.
Okay.
And we're diving deep into what D&O insurance doesn't cover.
Right. So we're talking about the exclusions.
Yeah, those tricky exclusions that can really catch you off guard.
That's right. These details are often overlooked,
Mm-hmm.
but they can really make all the difference when it comes to protecting yourself and your company.
Exactly. Think of it like this. Imagine you're trying to get car insurance after you've already had an accident.
Oh,
Chances are you're not going to get the coverage you need.
right.
Well, D&O insurance has similar traps, especially when it comes to events that happened before the policy even started.
One of the biggest pitfalls you need to be aware of is the known circumstances exclusion.
Okay.
This means if there's already a situation brewing, say a potential lawsuit waiting to happen,
Mm-hmm.
and you knew about it or reasonably should have known about it,
Right.
the insurer could deny coverage.
Hmm.
They might even say, nope, we're not covering that,
Right.
and you don't get your premiums back either.
Wait, seriously, they could just void the whole policy because of something that happened before I even bought the insurance?
Yeah,
That seems pretty harsh.
it is a harsh reality,
Huh.
and it highlights the importance of transparency
Okay.
when applying for D&O insurance.
So it's like they're saying, no surprises or you're on your own.
Right.
What kind of information could trigger this kind of reaction from an insurer? What should people be extra careful about disclosing?
One critical area is financial data. If you provide inaccurate financial information, the insurer could later argue that you misrepresented your company's financial health and use that as grounds for rescission.
Uh-huh.
Another red flag is failing to disclose any past issues that could potentially lead to a claim. Let's say your company was involved in a legal dispute a couple of years ago. Even if it was settled out of court, you need to disclose that.
Right.
It's better to be upfront and provide full transparency, even if it feels uncomfortable.
That makes sense. It's like a doctor needing your full medical history to give you the best treatment. So
Exactly.
you can't hide anything if you want the right protection.
Right.
So what other pre-policy pitfalls should we be on the lookout for?
Another important exclusion to understand is the prior acts exclusion.
Okay.
It's similar to the known circumstances exclusion,
Uh-huh.
but it specifically focuses on wrongful acts
Yeah.
committed before the policy was active.
Mm.
When we say wrongful acts,
Yeah.
it's not just limited to criminal activities.
Oh, so it's broader than that. What else would fall under that umbrella?
It could be anything that could lead to a civil lawsuit,
Yeah.
a breach of contract, a violation of regulations, even negligence in certain situations. And this is where it gets tricky,
Yeah, okay.
because it's not always black and white. What might seem like a minor oversight to you could be perceived as a wrongful act by someone else, opening the door for a potential lawsuit.
Wow, so it's not just about avoiding criminal behavior, it's about being aware of any past actions that could be seen as harmful or damaging to others. That really broadens the scope of what we need to consider, doesn't it?
It absolutely does. And that's why it's so important to have a thorough understanding of your company's history and to be proactive in identifying any potential red flags. If you have any doubts, consult with legal counsel to get a professional assessment. Remember, being transparent and addressing any potential issues head-on is the best way to ensure you have the D&O coverage you need when you need it most.
That's solid advice. Okay, so let's say we've navigated the pre-policy waters successfully. We've been transparent, disclosed everything, and our D&O policy is in place. But then the unthinkable happens, a claim is filed against one of your directors or officers. What kind of challenges might you face when it comes to actually using the insurance to defend yourself?
Well, one of the most common points of contention is the reasonableness of defense fees exclusion.
Hmm.
This is more prevalent in policies for private companies and nonprofits
Okay.
and can lead to some sticky situations.
Why is that? Are public companies treated differently in this regard?
Yes, they are. Public companies typically have the right to choose their own legal representation if they're sued,
Uh-huh.
and the insurer is generally obligated to cover those costs within reasonable limits. But with private or nonprofit policies, the insurer often has more control. They might get to choose the legal team and dictate how much they're paid.
So even if I have D&O insurance, my company might not get to pick our own lawyers.
That's a possibility.
That seems like a big deal, especially if you're facing a serious lawsuit.
It is a big deal, and it highlights the importance of understanding the specific terms and conditions of your policy. It's not just about having coverage. It's about knowing what kind of control you have over the defense process.
So what could go wrong in this scenario? What are some specific issues that could arise?
The main issue is that the insurer's definition of reasonable defense fees might not align with your company's needs or expectations. They might try to push for a less experienced or less expensive legal team,
Right.
which could potentially compromise your defense.
That makes sense. It's like going to a mechanic who only uses secondhand parts to fix your car.
Exactly.
You might save some money up front, but it could cost you more in the long run.
And the worst part is that you could end up stuck with a huge legal bill,
Oh.
even though you have insurance. If the insurer deems certain defense costs unreasonable,
Yeah.
they might refuse to cover them, leaving your company to foot the bill.
Yikes. That's definitely not what you want to hear when you're already dealing with a lawsuit. So what can companies do to protect themselves from this kind of situation?
The first step is to carefully review the policy language and understand how reasonable defense fees are defined. Don't be afraid to negotiate with the insurer up front to ensure you have more control over the selection of legal counsel and the defense strategy.
That's great advice. It's a reminder that D&O insurance isn't just about signing on the dotted line. It's about having an active dialogue with your insurer and making sure your interests are protected.
Absolutely. And speaking of potential conflicts with the insurer, there's another clause you need to be aware of that can create a real dilemma for companies' bores. The consent to settle clause. This one can pit the insurer's desire to control costs against your company's reputation and long-term interests.
That sounds interesting. Tell me more about that. How does this consent to settle clause work in practice?
Imagine this scenario. A lawsuit is filed against your company. The insurer, wanting to avoid a long and costly trial,
Right.
might push for a quick settlement, even if it means exhausting your policy limit. But settling might be perceived as an admission of wrongdoing, which could damage your company's brand and future business prospects.
Oh, I see the dilemma. On the one hand, you want to resolve the lawsuit quickly and efficiently, but on the other hand, you don't want to tarnish your company's reputation or set a precedent that could encourage future lawsuits.
Precisely. It's a delicate balancing act,
Yeah.
and the consent to settle clause can make it even more challenging. It essentially gives the insurer a significant amount of power in the settlement process,
Right.
which might not always align with your company's best interests.
That's a tough spot to be in. So what options do companies have if they disagree with the insurer's recommendation to settle? Are they just forced to accept whatever the insurer wants?
Well, there is another clause, unfortunately, that can make things even more complicated, and that's the hammer clause. This clause is designed to put additional pressure on the insured to accept the insurer's settlement offer.
Okay, this is where it gets really interesting. Tell me more about this hammer clause. How does it work, and what are the implications for companies?
Essentially, the hammer clause says that if you reject a settlement offer that the insurer recommends,
Okay.
and then you lose the case at trial,
Uh-huh.
you could be held liable for any amounts above that initial settlement offer. It's like a financial penalty for not heeding their advice.
Wow. That's a lot of pressure. So you're saying that even if we have D&O insurance, we could still end up paying a huge sum of money out of pocket if we don't agree to settle on the insurer's terms. That seems incredibly risky.
It is a risky situation, and it highlights the importance of having a strong legal team on your side who can assess the risks and benefits of both settling and going to trial.
So it's like a high-stakes poker game where you have to carefully weigh your options and make the best decision possible with the information you have. It sounds like navigating these settlement negotiations can be a real minefield for companies.
It can be.
You really need to have your wits about you
Right.
and understand all the angles.
Mm-hmm.
But even with the best legal advice, sometimes things just go wrong. So what happens if the claim falls outside the scope of what D&O insurance is designed to cover?
That's a great question, and it brings us to the limitations of D&O insurance.
Okay.
It's important to remember that D&O is not a one-size-fits-all solution. It's designed to cover specific types of risks, and there are many situations where it might not provide the protection you need.
Okay, so let's talk about those limitations. What are some common examples of things that D&O insurance typically won't cover?
One category you need to be aware of is other insurance exclusions.
All right. This basically means that if the claim could be covered by a different type of insurance policy, The D&O insurer might deny coverage. They're essentially saying, hey, this isn't our problem. You should have the right insurance for this situation.
I can see how that could lead to some finger-pointing and confusion. What are some examples of these other types of insurance that companies might need to consider?
Well, think about the types of claims that might arise in your specific industry.
Okay.
For example, if your company deals with physical products or provides services that could potentially cause bodily injury or property damage, you'll need general liability insurance
Right.
to cover those risks. And if you manage employee retirement plans, you'll need fiduciary liability insurance to protect you from claims related to mismanagement of those funds.
So it's like having a toolbox with different tools for different jobs.
Exactly.
You wouldn't use a hammer to screw in a light bulb run.
Right.
You need the right tool for the job, and the same applies to insurance. And it's not just about having the right policies in place, it's also about understanding how they interact with each other. You don't want to end up in a situation where multiple insurers are pointing fingers,
Right.
each claiming that the other policy should cover the claim. That's why it's so important to have a comprehensive risk management strategy that takes all of these potential exposures into account.
So it sounds like companies really need to be proactive and think about all the potential risks they face. Not just the obvious ones. They need to coordinate their insurance coverage to make sure there are no gaps or overlaps that could lead to problems down the road.
Absolutely. And it's not just about the big catastrophic events.
Right.
Even seemingly minor issues can create significant liabilities if they're not handled correctly.
What are some examples of those seemingly minor issues that could turn into big problems if companies aren't careful?
One example is contractual liability. Many D&O policies have exclusions related to breaches of contract. And you might think, well, we have a contract with our suppliers.
Right.
But that's not something that would typically involve our directors and officers. But here's the thing, even seemingly routine contracts
Okay.
can create unexpected liabilities if they're not carefully worded and managed.
Okay, I'm starting to see how complex this can get. So how can companies protect themselves from these kinds of contractual liabilities? What should they be looking for in their contracts?
The key is to pay close attention to the language of the contract and to understand the potential implications of every clause.
Okay.
For example, does the contract include indemnification provisions that could expose your directors and officers to personal liability? Are there any limitations on liability that could benefit your company?
Right.
These are all important questions to consider.
So it's not enough to just sign on the dotted line. You
Yeah.
really need to understand the nuances of the contract
Right.
and how it could impact your company's risk profile.
Precisely. And if you're not comfortable interpreting the legal jargon yourself, don't hesitate to seek legal advice. A good lawyer can help you identify potential red flags and negotiate favorable terms that protect your company's interests.
That's sound advice. It's always better to be safe than sorry, especially when it comes to contracts that could have significant financial implications. So we've talked about pre-policy pitfalls, defense dilemmas, and situations where D&O insurance might not apply. But what about those situations where the actions of a director or officer are clearly wrong? I'm talking about intentional wrongdoing, not just bad business decisions. Does D&O insurance cover those kinds of situations?
That's an important question, and the answer is not always straightforward. While D&O insurance is designed to provide protection for directors and officers, it's not a shield for illegal or unethical behavior.
Okay.
There are specific conduct exclusions that draw a line in the sand, and if those lines are crossed, coverage could be denied.
So there are limits to what D&O insurance will tolerate. What kind of conduct would typically trigger these exclusions?
One of the most common exclusions is for fraudulent or criminal conduct.
Okay.
If a director or officer is found to have engaged in activities like embezzlement, insider trading,
Right.
or other forms of financial fraud, the insurer is very unlikely to cover any resulting losses or legal expenses.
That makes sense. You can't just use D&O insurance as a get-out-of-jail-free card for criminal behavior. But what about situations that are less clear-cut,
Right.
where there might be some gray areas? How do insurers determine whether conduct is truly fraudulent or criminal?
That's where things can get complicated. The insurer will typically conduct their own investigation to determine the nature and extent of the wrongdoing. They'll look for evidence of intent knowledge and deliberate deception.
Right.
And remember, the burden of proof for denying coverage based on a conduct exclusion is often lower than the standard of proof required in a criminal court.
So even if a director or officer isn't convicted of a crime, the insurer might still deny coverage if they believe the conduct was intentional and dishonest.
That's right. And it's not just about criminal charges. Even civil lawsuits alleging fraud or other intentional wrongdoing could trigger these conduct exclusions.
This is all starting to sound a bit ominous. Are there any other types of conduct that could lead to D&O coverage being denied?
Another common exclusion relates to illegal profits or compensation.
Okay.
If a director or officer is found to have personally benefited from illegal or unethical activities, the insurer is unlikely to cover any related losses.
So if a director uses their position to enrich themselves at the expense of the company or its shareholders,
Right.
they're on their own.
Exactly. These exclusions are designed to ensure that D&O insurance is used for its intended purpose,
Right.
to protect directors and officers from honest mistakes and unforeseen liabilities,
Hmm.
not to provide a safety net for those who engage in deliberate wrongdoing.
That makes sense. It's about accountability and ensuring that those who abuse their positions of power don't get a free pass. So we've talked about situations where the conduct of a director or officer might trigger an exclusion. But what about conflicts within the company? What happens if colleagues start suing each other? Does D&O insurance cover those kinds of internal disputes?
That's a great question. And it brings us to a category of exclusions known as insured versus insured exclusions.
Okay.
Traditionally, many D&O policies included broad exclusions for claims brought by one insured party against another. The idea was that the insurer didn't want to get involved in internal squabbles or be seen as taking sides in a company's internal conflicts.
So it was basically like saying, you guys work this out amongst yourselves, we're staying out of it.
Exactly. However, in recent years, there have been some significant developments that have made these insured versus insured exclusions more complex and nuanced.
What kind of developments are we talking about? What has changed the landscape for these types of claims?
One of the biggest changes has been the rise of whistleblower lawsuits. The Dodd-Frank Act, passed in 2010, included a provision that incentivizes whistleblowers to report corporate wrongdoing by offering them financial rewards and protection from retaliation.
So if an employee witnesses something illegal or unethical happening within the company, they can blow the whistle on their colleagues without fear of losing their job or facing other negative consequences.
That's right. And the Dodd-Frank Act has had a ripple effect on D&O insurance because whistleblower lawsuits often involve claims by one insured party against another.
Right.
For example, an employee suing a manager for retaliation.
Uh-huh.
Insurers have had to adapt their policies to address this new reality.
So it's no longer a simple case of just excluding all insured versus insured claims. There are exceptions now, particularly when whistleblowers are involved.
Precisely. Many D&O policies now have carve-outs or exceptions for whistleblower claims,
Okay.
meaning that coverage may still be available in these situations, even if the claim is brought by one insured party against another.
That's interesting. It sounds like the legal landscape is constantly evolving and D&O insurance has to keep up with those changes.
It absolutely does. And that's why it's so important to stay informed about these developments and to regularly review your D&O policy to make sure it provides the coverage you need in today's complex business environment.
So it's not a set it and forget it kind of thing. You need to be proactive and make sure your D&O insurance is keeping pace with the changing legal and regulatory landscape.
Absolutely. And remember, knowledge is power. The more you understand about your D&O policy and the potential exclusions, the better prepared you'll be to protect yourself and your company from unforeseen liabilities.
It's been quite a journey exploring these D&O insurance exclusions.
It has.
I have to admit, when we started, I didn't realize just how much there was to learn. It's definitely not light reading,
Right.
but it's incredibly important stuff.
It is. D&O insurance is often seen as something only CEOs and board members need to worry about. But as we've seen, these exclusions can have implications for everyone in a company.
Right. It's not just about protecting the top brass. It's about safeguarding the entire organization from potential financial disaster. And understanding these exclusions is crucial, even if you're not directly involved in managing the company's insurance policies.
Exactly. The more people in an organization who understand these concepts, the better equipped the company will be to make informed decisions and avoid costly mistakes. It's all about creating a culture of risk awareness and proactive planning.
I love that a culture of risk awareness. It's like having collective safety net where
Hmm.
everyone understands their role in protecting the company's well-being. But I think what's been most eye-opening for me is the realization that D&O insurance isn't a magic bullet. It's not a get-out-of-jail-free card for reckless behavior.
That's a crucial point. D&O insurance is designed to protect against genuine mistakes and unforeseen circumstances, but it's not a license to act irresponsibly or engage in unethical behavior.
Right. It's like wearing a seatbelt in a car. It's there to protect you in case of an accident,
Right.
but it doesn't give you permission to drive recklessly. You still need to be a responsible driver, and the same applies to running a business.
I couldn't agree more. D&O insurance is a valuable tool, but it's only effective when used responsibly and in conjunction with sound business practices, ethical decision-making, and a comprehensive risk management strategy.
So what's the one key takeaway you hope listeners will remember from this deep dive? What's the most important piece of advice you would give them?
I would say this: don't take your D&O insurance for granted. Take the time to understand your policy. Familiarize yourself with the exclusions and ask questions if anything is unclear. Knowledge is power, and in the world of D&O insurance, that knowledge can be the difference between financial security and a potential catastrophe.
That's fantastic advice. And it's a reminder that we all have a role to play in protecting our companies and ourselves from these potential risks. So to wrap things up, I want to leave our listeners with a thought-provoking question to ponder. As you go about your day-to-day work, think about this. What potential blind spots might exist in your company's D&O coverage? Are there any areas where you might be unknowingly exposed? Take the time to reflect on this and perhaps even initiate a conversation with your colleagues or risk management team. It's always better to be proactive and address potential issues before they become major problems.
That's a great point to end on. Risk awareness and proactive planning are essential for any successful business.
Thanks for joining us on this deep dive into the fascinating and sometimes bewildering world of D&O insurance exclusions. Until next time, stay curious and stay informed.